More and more advisors are using universal life policies, whether it's IUL, VUL, regular UL, these policies for the infinite banking concept, for the concept of accumulating cash within your life insurance policy. Today, we're going to talk about why it's so important to make sure you're monitoring your universal life policies to make sure they're performing the way you expect them to and the way you want them to perform. Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
So whether you have a VUL, variable universal life, IUL, index universal life, or a regular UL, universal life policy, it's important that you monitor them. Basically, a universal life policy is a broken down whole life policy, right? So the whole life policy is bundled, the universal life is unbundled, and it's bundled into an annual renewable term policy where the term insurance increases in cost as you get older every single year, and a separate cash account that builds and also supplements the term policy if necessary.
So universal life literally unbundles three components that make up a life insurance policy. There's the mortality cost, the cost of insurance. There's the expense load, what it costs to run the company. And then there's the interest component, the interest that the insurance company is making on the money that it's collecting. So what universal life does is it unbundles those three components. You have a separate charge for mortality, a separate charge for expenses, and a separate accumulation of interest earned. In whole life, it's all bundled. It's all done neatly for you by the insurance company. So the selling point on universal life is that if there's savings on mortality, less people die sooner rather than later. There's savings on expenses, meaning that it costs less to run the company than the insurance company initially anticipated. And there's excess interest, meaning that the insurance company earned more interest than they initially assumed they were going to earn. All of that could be funneled back to create excess interest that's credited to your policy, which, by the way, is exactly what happens in a whole life policy through dividends. So with universal life, the big selling point is if you have savings on mortality, savings on expenses, and excess interest, you can utilize that to have flexible premiums. Well, the problem with flexible premiums is that they're flexible. And people interpret that as to they don't need or don't have to pay the premium. And that could be true in 1 year. But the problem is you're setting yourself up for failure down the road.
Right, because all three of these components, the costs can go up and the costs can go down. But as time goes on and the world changes, it's more and more likely to go up, as we're seeing now.
Well, for sure. And the key with whole life is that if any of those things happen, right? In other words, if more people die sooner rather than later, that means there's no savings on mortality, or it costs more to run the company than was originally assumed. There was excess expense cost, or interest rates were lower than assumed, so there was a deficit on interest earned. Any three of those things, or all three of those things, if any of it happens, the insurance company can't change the deal.
All right. So all of the risk with the whole life policy is on the insurance company. But in contrast with the universal life policy, no matter what kind, part of that risk is assumed by the policy owner.
Unknowingly and unnecessarily. Unknowingly means nobody explained it to you that way. And unnecessarily means it doesn't have to be that way.
So a lot of times people will bring us their universal life policies. They'll request an in-force illustration or they'll bring us their annual statement to review. And what we find is there's not enough cash value and there's not enough premiums within those contracts to maintain the death benefit, which leads to a problem, right? So the cash value is going down, the premium staying the same. And we don't want to let that policy lapse, right? Because we've paid all these premiums to maintain this death benefit. And it comes to a point where the policy owner has to make a choice. They either have to pay more premiums or they have to lose all of the premiums paid and the death benefit at any given point.
Well, and that's the sad part about it, because you generally lose or decide to walk away from the policy because A, you can't afford the prohibitive premiums that are going to be required in order to keep the policy going. And you're much closer to the inevitable day you die.
So what we'll see most of the time with a universal life policy, unless it's super overfunded, which I've never seen, is the cash value will grow over time because the cost of insurance is lower than the premiums we're putting in. And then it'll switch and the cash value will start to decrease because now the cost of insurance costs more than the amount of premiums that are going in, which is fine. But what'll happen is if you don't put more premiums in, that cash value will continue to get eaten away until the policy will eventually lapse and you lose all of those premiums put in. There's no cash value left, and you ultimately lose that death benefit as well.
And that's really the problem. You see, with whole life, none of that could happen. Mm-hmm. Again, the insurance company is assuming all of the risk. So life insurance, as any insurance, is literally a transfer of risk. You know, if you insure your home for $300,000, you're literally saying to the insurance company, I have a $300,000 risk that I don't choose to assume. I will transfer that risk to you. What would it cost if I do so? And the insurance company calculates a premium, and then you decide if the premium is worth it. Spoiler alert, very few people walk around without having insurance on their house. Well, it's the same with life insurance. You're literally saying to the life insurance company, I have a risk of, let's say, $100,000. I don't choose to assume that risk. If I die, my family needs $100,000 or my business needs $100,000. I will transfer that risk. What will you charge me? Now, the key is that with whole life insurance, the net amount at risk goes down because the insurance company is putting money away to guarantee that if you reach the age of maturity, they have the cash available. With universal life, it's not that simple. The net amount at risk is not guaranteed to go down because you could have excess charges over and above what was planned as far as the premium. And when that happens, the money be paid to the insurance company. If there's a deficit in the premium paid versus the costs charged, the insurance company debits that money from your cash value. And now you have less cash value than you did the year before. And now, which means there's a greater net amount at risk, but now you're a year older and the net amount at risk or the cost of insurance increased.
So let's think about it this way. If you have a universal life policy, you're walking around with part of this risk, which may not be what you signed up for when you purchased that contract. So what could you do? Well, you could transfer that cash value that's built up within the policy to a whole life policy if there's cash value and if you're still insurable, if your health doesn't prohibit you from getting a whole life policy. If you're not healthy and you're not able to get a new policy, you're going to have to look at, okay, how do I fund this contract and can I afford to fund this contract to stay in effect longer than I do?
Well, in essence, what you're saying is you're going to have to increase the premiums. And that's the key, right? So the bottom line is this. A properly funded universal life policy still has some risk, but if it's properly funded, it's generally funded at a level at or beyond the level of a whole life policy. And what people don't realize is that the best they could expect from a universal life policy is exactly what they would get with a whole life policy without the risk. So the question becomes, why take the risk if you don't understand what that risk exactly is?
So if you have a universal life policy, here's what you need to do. On an annual basis, you need to request an in-force illustration to make sure that policy is still performing the way you anticipated it to perform. You also need to analyze the amount of premium that you're putting towards that policy, because the longer you put in more premium to meet your goal of how long you want that policy to stay in force, the less you're going to have to pay over time, right? Because once you're 65, 70, the amount of premiums that you need to put into the policy to maintain that death benefit is going to be very high. And you may come to a point where you're putting in more premium dollars over the life of the policy than your family is going to get for the death benefit. And that's not an ideal situation.
Yeah, and I think really you're weighing two things, right? When you buy insurance, we've been trained to buy insurance by saying the lower the premium, the better. But that's not necessarily the way you buy life insurance. And so what happens is if you pay more premium, you have less risk. If you pay less premium, you have more risk. So you have to decide what's more important to you, saving on premium or certainty of a payout.
Right. Absolutely. If you'd like a free analysis of your universal life portfolio, be sure to visit our website at tier1capital.com to schedule your free strategy session today. We'll see how you could rescue your universal life policy cash values and if it makes sense. Also, if you like this video, be sure to give us a thumbs up and check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep. That really matters. We'll see you in the next one.